Hi, everybody. Good morning, good evening. Thank you, everyone, for joining in. My name is Abhilasha Sharma. I'm a practice director with the firm and I lead our retail and CPG program. I'm joining in from Gurgaon, India. And I really look forward to today's conversation. And now I'll let my co panelists introduce themselves. Over to you, Akash.
Hi everyone. I'm Akash, a senior analyst at Everest Group. Been part of the firm and I'm part of the retail and CPG practice. And yeah, just looking forward to this webinar. Over to you, Abhishek.
Thank you, Akash. Hello, everybody. My name is Abhishek AK. I'm Vice President at the firm. I lead the Industry Solutions Group, which comprises of retail and CPG, a topic which is very close to my heart. Looking forward to the discussion today. To the panel discussion today, I'd be bringing in a perspective or a balanced view between both enterprises and providers, and looking forward to the discussion. Next slide, please. So just a quick roadmap of what we'll be covering in the webinar today. We'll be starting with the performance review of leading RCPG enterprises. The team has done some very interesting analysis on how RCPG brands have performed over the last 2 to 3 years. And then we'll be moving on to my favorite section, which is bold predictions for 2026 and what would be the sourcing implications for this. And then coming into sourcing dynamics in 2026, followed by the most interesting part, which is the Q&A. Looking forward. Please, next slide, please. So before we get started, we saw that as per the registration, there are more than 200 participants into this webinar, comprising of many leading CPG brands. And one of the poll questions that I thought would be ideal is to start with was, how do you think your organization was able to meet its expected growth in 2025? So realize that while this question is targeted to CPG brands, I understand that there are some partners who are serving CPG brands which are also part of this discussion. So feel free to add what you think is the answer. Abhilasha, if I tell you myself, I think barely made it would be the answer. What do you think?
Same, Abhishek. I think this, even if we refer to, let's say, the NRF sales data, retail sales data, we have almost reached the pre-COVID levels. So I would say not a surge rarely, but something very close to barely made it to we met most of our targets. That would be my pick. Akash, any quick thoughts on from your end?
Yeah, I think 2025 was a slow year, but I guess a positive sign is that it's better than 2024. So those will be my 2 cents on this.
Great, great. So, do we have the results? I think.
Yeah, I think the results read that
Milan?
uh, most of the
Yeah,
folks feel that they fell short. And I think there's an even split. Some folks are saying that, yes, we exceeded our expectations. Some are saying that we barely made it. So mixed bag, which I think is the analysis that we have also brought up in the subsequent slides. Next slide, please.
right, right. Great. So, again, this is a very interesting analysis that our team has done, and at the right time of the year now that we are about to close 2025. So, this is kind of a performance report card for the top retail and CPG companies. So, we have sort of split it into top 50 percentile and bottom 50 percentile based on the year-on-year revenue growth that we have seen. The trend graph has been split into retail and CPG industry separately. Retail is the green trend line and CPG is the blue trend line. So my top 3 or 4 key takeaways from this particular assessment would be, first of all, after continued slowdown for the last 2 years, 2025 was a turnaround year. That was a turning point, and now we expect more predictable, fundamental driven growth in 2026. So, a positive sentiment. Second important observation was, if we really try to understand what was that common formula, winning formula, at least for the logos who were able to outperform the slowdown in the industry, it was investing in the fundamentals, which was accelerating your D2C portfolio, localizing your supply chain, investing in recurring growth engines. It could be things like loyalty, which sort of enhance the stickiness of the customers. This helped them to sort of capture share even in a slower market, a relatively slower market. So, talk about Amazon. They were amazingly on point in terms of accelerating their online sales or sort of diversifying into non retail revenue streams as well. It could be retail media, subscription, logistics, etc. Another case in point, Home Depot. Home Depot was sort of part of an industry which was less impacted by the overall macroeconomic volatility, which was home improvement. And they invested in sort of building their supply chain for future at the right time. So these were some examples which were able to outperform the overall industry. Now, again, one very interesting analysis that we are able to bring to you is an intuitive question which might come to mind of most of our audience today. Why did retail outperform CPG? Because we see a big divergence here. So now fundamentally CPG feeds into the overall retail industry, but we see there is a directional correlation, but they are not equal. The reason being retail is a more diversified industry, which has far more categories, services, etc. Private label was again one of the things that sort of helped them hedge their overall risk and investment in their data-led platforms. Those were few of the things they were able to outperform CPG as an overall industry. Now, if we flip to the bottom 50 percentile, which is the next slide, there we are able to understand what went wrong for at least few logos who were part of the top bottom 50 percentile. And few common themes that came out were, especially for CPG companies, there was over reliance on the value part and even the volume part or volume growth failed to deliver. They were squeezed from both ends due to inflation rising, due to labor cost rising, transportation cost rising, and the consumer appetite was also very constrained in this tough macroeconomic situation. Some of the logos that you see here, they were really struggling with a lot of their legacy tech debt or their legacy operating models. So the bottom line is from the entire analysis of top 50 and bottom 50, the bottom line is that there needs to be a differentiated value proposition that logos they bring to the table, scale is not enough. So if I take a very relevant example, again, same category, Home Depot versus Lowe's. Home Depot was part of top 50, outperformed the trend. Lowe's was part of the bottom 50. The reason Home Depot was able to sustain growth because it built a structurally superior system, investing in the right stakeholders and investing in modernizing the supply chain ecosystem early on. Lowe's was on track, but not as much as Home Depot. That's why we see that the winners of the 2025 they grew not because of the demand, but their operating models were strong and built for future. Now, what does that mean for our audience, our enterprise audiences? That should be the driving theme for your IT investments. So market will not reward folks who are bigger in size, but the ones who are digitally built, they are lean and faster and agile to adopt to the market. So this was our overall analysis from 2025 reflections. Again, a bittersweet story. But now I would like to invite Akash. Akash, what stood out for you? What were the bigger forces underneath this data? If you can help us walk through some of the mega trends that you expect in 2026.
Yeah. If you can flip to the next slide, please. So let's start with the first major megatrend that we are seeing in the retail landscape. And it is a bit of a dramatic one. So store closures are accelerating at a pace that we haven't seen since the pandemic. And it's fundamentally reshaping how the CPGs think about the distribution, demand capture, and the brand experience. If you take a look at the chart on the left, the numbers tell a very clear story. Between 22 and 24, annual store closures were averaging like 5 to 7K per year. But in 2025, that number is projected to jump between 12,000 to 15,000 closures. That is nearly a five times increase. and a massive signal of structural pressure. And this isn't just happening at the fringes of retail. We are seeing both mass market and premium players recalibrate their footprint. We'll take an example of Uniqlo in Hong Kong. Rather than expanding aggressively, they are now prioritizing renovations, larger store formats, and localized assortment strategies. The focus here is very clear: fewer stores, but a nice, richer experience and stronger local value proposition. Similarly, Sephora in Singapore, it's leaning towards store upgrades instead of store proliferation. Instead of being the opening in new locations, they are refreshing the existing ones. Now, while physical footprint is shrinking, on the counter side, we see that the digital channels are absorbing more of the demand. We take a look at Walmart's recent Q3 earnings. They report a heightened amount of e-commerce. The e-commerce was increased and up by 27% globally as compared to the same in the past period of last year. And even if you look at Target recent Q3 results, while the quarter sales were down 1.5% as compared to 2024, the digital comparable sales grew by 2.4%. The digital momentum here is effectively cushioning a lot of the offline weaknesses for some of these players. But perhaps the most visible cracks come when we talk about the segment of departmental stores and pharmacies, where the structural pressures are the most severe. The pharmacies are under a similar strain. CVS recently announced 270 store closures, which they plan to do in 2025, and the same is being mirrored for Walgreens and Rite Aid as well. With prescription volumes low, operating costs rising, the footfall is continuing to be erratic. And even when we talk about fashion, Macy's CEO earlier this year stated that they're going to be closing 150 stores, which will be critical to their survival as part of their bold new chapter strategy. They did end up closing 66 stores this year, and yesterday, to everyone's surprise, Macy's actually reported a strongest comparable sales growth in the last 13 quarters, with their net sales actually exceeding guidance. The big takeaway from all this is that physical retail is being rebalanced. It is not being abandoned. Retailers are no longer chasing store count anymore. They're chasing experience density, digital conversion, and operational efficiency. And for CPGs, this changes everything from your route to market models to shopper marketing investments, field execution, supply chain design. Everything will need to be changed. Now, talking about CPGs, if we can flip to the next slide, please. I present the second megatrend of 2025. As we look across CPG landscape in 2025, we see that growth has been less about volume and more about value. Brands have been doubling down on their premiumization and transforming how they craft, price, and position their products. Look at what's happening with some of the biggest players, big CPG brands, Unilever, Coca-Cola, PepsiCo. They've all invested in premium SKUs. CPG brands which were betting on their consumers' desires to pay for quality or experience. Companies were introducing premium or functional SKUs. We have all seen products around natural, wellness oriented, higher quality versions of your everyday goods. And these are not just niche launches, they have become a centerpiece to their growth strategy. Simultaneously, we have also seen that companies are sharpening their revenue growth management. There has been a big push for data, granular market segmentation, dynamic pricing, pack size or optimization. We have heard everything being leveraged to fight this inflation and the demand shifts. And that approach has worked and it helped protect their margins and their sustained growth. But the signals are now shifting. Premiumization is no longer a differentiator because every brand has a premium offering. What remains true is relevance, channel agility, smart pricing, efficiency. For CPGs and their partners, the lesson is very clear. Premiumization and value-led innovation alone will not let you drive the next phase of growth. That means you need to have new supply chain models, intelligent trade and management, dynamic pricing, agility to shift between value and volume depending on the market pressure. So I would like to actually invite Abhishek here. Abhishek, you have long emphasized the importance of restoring value momentum in CPG. With value-led growth kind of hitting its limits, what does the next phase look like?
Yeah, thanks, Akash. So good. This is some very interesting analysis that I think everybody should be considering. So don't get us wrong, right? Uh, Focusing on value growth is required, but also on volume growth. Obviously, the key thing is how do you balance growth for both of them? How I see CPG brands now nuancing their strategy would be something which I termed as value-oriented volume growth. What that means is that CPG brands, in order to navigate the volume and value equation, would be now forced to do very strong portfolio restructuring. That would mean, getting rid of low performing assets or SKUs, and even at certain times low performing companies or brands within their entire portfolio. Second thing would be on rapid orientation or on operational efficiencies, and maybe on new commercialization strategies as well. Pushing the D2C commerce, pushing the retail commerce, using RMN, as you said, in order for a value and volume driven growth business. Coming to this analysis, I see that some of the brands that I have listed in this chart are actually participants of this webinar as well. So let me take the example of Kimberly Clark over here. So if you see over here, Kimberly Clark is on the other end of the spectrum, which is volume focused. And what they have done recently, as you know, is that they have acquired Kenvue brand. So traditionally speaking, Kimberly Clark has been synonymous with products like Huggies, Kleenex. All of those thumbs come into the category of hygiene products, right? And with the acquisition of Kenvue, now the shift that Kimberly Clark is trying to take is positioning itself not only as a hygiene and a household brand, but a overall health and wellness brand, right? Because the Kenvue brand gets that, health and wellness portfolio into the mix. Now, the good thing as I see it is that with the acquisition of, or with the coming of these two brands, uh, the resultant entity will be able to increase its value and volume growth, right? So while Kimberly Clark focusing on high volume products but low margins, that's the other side of the story for Kenvue. That being said, one of the key things is that all M&As at beginning look very nice and think that they are a match made in heaven. There are a certain pitfalls also which come. Let's go to the next slide, please. So the megatrend 3 that I think is going to play out is that the structural fatigue from the 2010 era of diversification is peaking and also driving a decisive shift from portfolio expansion to portfolio precision. So we all know about the deal of Kraft Heinz in 2015, backed by the largest of investment bankers, largest of the funds, right? And it was said to be a match made in heaven, right? So if you look at the underlying rationale for the deal, so Kraft had 98 or 99% of its business coming from North America, focused on grocery staples and packaged meals. And Heinz, on the other hand, had more than 60% of its revenue coming from non-North America regions, right? Especially emerging markets. So when this uh, unification of brands took place into Kraft Heinz, everybody thought that this is going to be the next or the biggest M&A or a biggest merger which has seen in the market. And by numbers, it was. So it would have, or it was by numbers, the third largest consumer goods company in the world, right? But juxtapose that to September 2nd, 2025, and we see that the Kraft Heinz brand has announced to segregate into two scaled focus companies. One is Global Taste Elevation, and the other one is North American Grocery Company. Now, if you look through, the underlying reason for this is when the two brands came into place, of course, the objective was cost realization or cost efficiencies. In fact, I think they had targeted around 1.5 billion in cost savings over the 2 or 3 years period, but they missed out on certain very fundamental aspects. One very fundamental aspect is the change in consumer behavior and preferences. And in fact, I'm guilty today that Bilasha and I were speaking to one very large food and beverage manufacturer, and they said that right or keeping up with changing consumer preferences is now showing in their margin and in their growth story as well. So consider Kraft Heinz as an example, mostly focused, or the entire or one part of the portfolio focused on processed foods, But as Akash, you rightly pointed out, consumer preference is now changing towards, healthy foods. So having a large portfolio of processed foods, is it something which is a really value differentiating? Probably it didn't turn out to be the same. The second thing, which I think is very crucial when you look at these two big portfolio companies coming together, is the because of these two big portfolio coming together, is because they were so large in scale, they were so large in brand, they were having so many brands. The innovation in each and every brand actually took a backseat. So there was not much of new SKUs or product portfolios which are coming into the market. And third and most important thing, which I believe, which was a point that Abhilasha pointed out, was the coming up of private retailers, okay, or private retail goods, because that also impacted their positioning. So now what Kraft Heinz has decided to do is, make two assets. I think they're roughly 10 to 15 billion each, and having a very targeted approach. And I know that the Global Taste Elevation Company is something which is still in the works, but I like that name very much because it is appealing to the customers at an emotional level, saying that how we will elevate the taste. And the second company, which is North American Grocery Company, gives a very clear value proposition to its customers that, this is going to be focused on grocery retail. Next slide, please. So we go into the bold predictions for 2026 and sourcing implications. I think next slide, please. We'll start with the poll. And again, one of these polls, we are interested to see how people respond to it. So the poll question is, which one of these will you see aging the fastest? Or put it the other way, which you think will be outdated by the end of 2026? The options are retail media networks, other is quick commerce, third is generative AI as a differentiated story, and last is personalization as a marketing buzzword. Akash, let me go to you first. You have made this poll. When you were making these polls, what was the answer that you thought you will give?
Abhishek, so I actually want to say what it's not going to be. I don't think retail media is a hype because, as of the latest earnings report of Walmart, their advertising business and their Walmart Connect, which includes Walmart Connect, it has been up 53% as compared to last year. So, at least from the perspective of the retailers, retail media is certainly working. uh, Advertisers will still need to see because with all the murkiness around attribution and inconsistency with reporting, as well as all the walled gardens, it is still up there. But from the perspective of the retailers, this is certainly working.
Okay, I
Abhilash, I
think
think the results
let
are
me chime
in.
in here. Yeah, let me chime in here. The results are actually in favor of what I was also thinking. So, generative AI as a differentiator story that has come out to be a clear winner. Personalization is a close second, but I think I totally agree with the audience here. Generative AI now is gradually becoming table stakes. We see adoption rising. That's why that will no more be a differentiator. It will be something like a bare minimum functionality, bare minimum technology that would be needed across the emerging commercial constructs, across emerging use cases in the CPG value chain. So great that we had this. Now this brings us to the most awaited part of today's discussion. I think everyone was excited about it. We have talked about what might fizzle out in 2026 in this poll, but let's flip the script here and see what will accelerate in 2026. And the fun part is each of us will make one prediction. So, viewers, you can ring us up 1 year from now and you can decide the winner. And let's see who comes out to be the fortune teller out of three of us. But I'll go first. So, by 2026, what I believe will be one of the mega trend or bold prediction would be we've been talking about omni channel a lot, but now it will elevate from channels to more about ecosystem. So what I strongly believe is we'll start hearing more about ecosystems, convergence of commerce, loyalty, payments, services, all of that collapse into a single customer super app experience. And the real catch here is this is something which has happened in some other parts of the world, like APAC, in ANZ. These things are very real. The concept of super app, it's way ahead. But the real shift will come in regions like US and North America, which have been a little bit of a laggard because of the high data regulations, that kind of a landscape. But now we will see that shift coming, and 2026 might just be the year for it. So now the idea is the retail app, as we know it, is almost dead. So consumers now they are demanding more of lifestyle ecosystem. So what this will mean for enterprises and a lot of our audience today would be that the firms they will now shift from owning just that transaction or that individual experience to now orchestrating the entire ecosystem. So and what this will mean for a lot of partners or providers who have also joined today's discussion is that now the sourcing will pivot from just channel vendors to ecosystem integrators. So there will be a lot of cross brand, cross industry alliances. Case in point, Kroger has recently partnered with Uber Eats. Walmart has partnered with ChatGPT. So Kroger did that to bring in the food delivery along with the grocery. So again, expanding into different categories. Walmart did it with ChatGPT to sort of personalize and integrate the payment experience along with the chatbot kind of an experience where you can directly make a transaction using ChatGPT. Again, two very different industries, very different ecosystems. And there are endless examples, right? One of the top American airlines, they have, in fact, partnered with Uber. Now, all of this bringing in this cross industry ecosystem, while there's a big opportunity in terms of offering an integrated personal experiences to customers, it's a lot of like we are looking at a big technology challenge ahead of us in 2026, which is the opportunity for a lot of partners to actually enable that integration smoothly. So retailers and CPG companies, they will increasingly plug into these multi-industry platforms to unlock better reach, better rewards, better stickiness of customers. So that's my take for 2026, that the winners in 2026 will be the ones who will stop building or at least stop focusing, restricting to channels, but the ones who will start building these ecosystems. That's where the future lies. Now, I'm really excited to know what my co-panelists believe. So, Akash, what's your bold move for 2026?
Yeah. If you can move to the next slide, please. So, my bold prediction for 2026 is that physical AI will redefine our CPG operations. So, generative AI was the big thing a couple of years back. Agentic AI took its place this year, and the next step in the world of AI will revolve around physical AI. The fusion of artificial intelligence, robotics, sensors, computer vision, drones, edge automation, like it all seems like that's the next step for AI. It will truly transform our CPG supply chains into self-learning, self-correcting systems. So let's start the conversation on the consumer side because that's where the pressure originates. Customers have moved well beyond a desire for convenience. They are now demanding autonomy. They expect shelves that will never run out, the replenishment that feels automatic, and the fulfillment that happens instantly. In fact, 74% of the shoppers say that they will abandon a brand after three or fewer bad experience. That could be stockouts, late deliveries, or simply a substitution that they did not approve. This customer intolerance for friction will be forcing retailers and CPGs to redesign their operating models entirely. We have already seen companies scale physical AI to meet these expectations. Industry forecasts suggest that companies applying physical AI can cut inventory costs by 20% and reduce stockouts by up to 50%, which is game changing in a category where margins are often thin. So consider what we've seen recently from Walmart. Walmart has doubled down with drone delivery expansions across several US cities, dramatically shortening last mile times. They've also sold their advanced robotics unit to Symbiotic while simultaneously entering a long term commercial partnership. This effectively is outsourcing innovations while securing capability. But let's also keep in mind the recent example of Kroger, where they announced that they will be closing three underperforming automated warehouses, which were developed using a UK technology company's tech. But nevertheless, we expect enterprises to converge IT and OT outsourcing. Traditional automation service providers, they will be outshined by those with integrated offerings, and the outcomes such as stock out reduction, fulfillment speed, these will become more key ROI measurements indicators in the deals. So the big message here is that physical AI isn't an experiment anymore. It is poised to become the next operating system of modern RCPG supply chain. Okay, so on to you, Abhishek. What's your big bold prediction for 2026?
Yeah, let's go to the next slide, please. So my big bold prediction is autonomous commerce will take off like crazy. I couldn't write like crazy in the slide, but I think that's the intent that I want to say. And AI agents will execute purchases and replenishments. So while putting this bold prediction, like we went through some of the data. So based on our ongoing research with enterprises and with consumers as well, see, we saw that, from decision making to delegation, 73% of the shoppers are using AI in their shopping journeys. 13% have used an AI agent. 70% say that they're at least comfortable using AI agents. But to my earlier point on how for certain consumer categories like single households where there is maybe two working professionals and have looking after a child, or maybe households where there is only one person in the entire household, for the repeat purchases I do not see any limitation in order to go for autonomous commerce, because that is going to give you convenience and value for money as well. And in fact, some of this has already been happening. If you see over here, Walmart is partnering with OpenAI to create AI first shopping experiences. And within Walmart itself, teams up with OpenAI to allow purchases directly into ChatGPT. In fact, one of the things that when I was putting this bold prediction, and to be honest, I was thinking, when is the time when I start seeing ads on OpenAI? Right now, OpenAI's user interface is very nice, right? And I know recently Sam had a discussion with his team that we'll push that for some quarters, but of course that is coming, right? That we'll start seeing ads on OpenAI, and what would that help is, it is not only helping retail and CPG brands, but also you have to realize that it is actually a consumer preference, that in case for low value repeat purchases, what is the purpose of me going and doing the same login for an app? Also, at the same point in time, autonomous commerce has more implications. Like, say, me and my wife are going to a shopping in Mauritius, right? What kind of shopping experiences we want to have so that we are well aligned to the needs of Mauritius? Those things will come very crucial. Now, what are the sourcing implications for this is very crucial, right? So what we see is enterprises will see partners capable of integrating AI commerce APIs and loyalty frameworks within one unified ecosystem. Secondly, and more importantly, and again, this was one discussion that we were having with the retail enterprise the other day, is that the contracts will evolve from simply click through rate. Okay. So click through rate, 2% click through rate is what I'm getting, to something which is based on conversions and accuracy based SLAs. Another KPI which we didn't put over here is return on advertising spend, right? We will not be focusing on marketing agencies just saying, okay, this is the plain vanilla return on advertising spend. How many of that spend was actually enabled with agentic AI or with commerce? And lastly, unified sourcing for conversational AI, data exchange, and retail media ecosystems, because those three things cannot work in isolation if you want to realize the benefits of autonomous commerce. An interesting thing is, I was going through some of the sales for the Cyber Week and also at the same point in time, Black Friday sales. So if you see over here and look at the data very intently, While of course there is a question on whether the actual value increased happened because of price increase or volume decrease, but one data was very clear that I think Salesforce put up this data that out of the 350 billion in shopping across those weeks for Thanksgiving and continued, around 60 billion of that was enabled with AI. So that doesn't mean that AI was making the autonomous purchase, but that consumers was using AI in order to get product recommendations and also using AI in order to resolve some product inquiries, right? So at least this is my bold prediction in three. In order to make this true, I will start using autonomous converse as and when that happens. But this is my bold prediction for 2026. Next slide, please. So now go into the sourcing dynamics for 2026. Before we get into the next slide, one of the things that you have to realize is that CPG brands or RCPG brands cannot make this pivot on their own, right? In fact, I would say to some extent, maybe it's not their job to do this pivot on their own. Their focus needs to be on focusing on value creation, product rationalization, product SKU formulation, but they have to work with partners that can help them make this jump. So now we are going into the section on how do we feel that the sourcing dynamics in 2026 will evolve. Next slide, please. So again, we start with the poll. Now, how do you expect your outsourcing spends to change in the next 12 to 18 months? And we have some data that we have done our analysis, but it will be interested to know what does the audience think that how much would their outsourcing spend on tech services change in the next 12 to 18 months? Again, Abhilasha, let's start with you first. What's your view?
I'm a little optimistic. I would say moderate increase would be my pick. We've been hearing positive sentiment from a lot of enterprise interactions that we have had. So, Abhishek, you were mentioning we today itself we interacted with a global CPG brand. We saw a lot of optimism in terms of where they want to spend, how they are perceiving AI, how they are actually creating different budget centers for AI. So my answer is a little optimistic. It would be moderate increase.
Akash,
Akash,
what
do
about
you
you?
have anything to say?
Yeah. So I am also in the team of moderate increase because we know that after 2025 there has been some skepticism about like how much is the industry going to grow. But with a continued push, I feel that the enterprises are starting to make those smart decisions, those smart investments, and 2026 is going to see a moderate increase in the budgets.
Good. I think Abhilasha, the results are there.
Yes, I think we are being really great fortune tellers today, Abhishek and Akash. Again, I think moderate increase is the one option that audience has also picked. So great. I think the bottom line is enterprises will increase their budget moderately with caution, precisely selecting the categories or areas where they would want to spend. And again, in a phased manner. So we are expecting less end to end kind of budget increases, but very selective areas, very precise surgical way to, their modernization or transformation journey. So, all right, next slide, please. Great. So, Akash, I think you had very interesting perspective about what we have
Yeah.
been hearing from enterprises. So, yeah, why don't you go ahead?
Yes. So in our latest study, we asked enterprise buyers what is their expectation for their budget change for 2026, and basis their responses, we are expecting a 3.5% of budget increase in 2026, which again closely aligns to what our audience had on the poll. It is a moderate increase, but it is still an increase regardless, and which does tie in with the rebound that we are witnessing in the overall retail and CPG industry. I think the bigger concern for the service providers here is the figure which we have on the right. Over half the enterprise buyers currently state that they do not They are not satisfied with their incumbents. We feel that dissatisfaction is only going to grow because enterprise buyers have started complaining that if service providers are able to replace their FTEs and they're able to automate their tasks with AI and reduce their costs, why aren't those savings being passed down to the buyers? Such dissatisfaction will only result in more portfolio reshuffling and vendor consolidation. Talent continues to be the largest area of dissatisfaction for the enterprises. Complaints about the quality of talent, attrition, inability to scale due to a weak bench. We have been hearing it year after year. Another common complaint is around proactiveness. Enterprises feel that at times they have to be the one that has to go to their service partners and ask for a solution rather than the service partner bringing it to them on their own. So, again, a constant area where we see complaints from enterprise buyers. So, Abhishek, I actually want to turn to you and I want to bring you in here. We are seeing that dissatisfaction has been creeping up across multiple dimensions. From your perspective, what are the missteps that the service providers are making that is leading to this kind of a trend?
Yeah, before we get to that interesting analysis, Akash, and one of the things that I saw was, the levers, client management, technical expertise, pricing, domain. So, that actually gives you a hint into what are the things that can elevate a provider's performance. But next slide, please. So, what I am saying is there are five pitfalls that any service provider should avoid at all costs. First and foremost, relying on credentials around delivery size or FTE count instead of measurable impact on margin growth and experience. Second is reusing horizontal success stories to showcase category specific proof points. Third is treating transformation as plug and play. And the last 2 points I think are fairly self-explanatory. But let me take a step and actually speak to you on one of the things that I feel that providers can do meaningfully different. Let me start with reusing horizontal success case studies. So what we mean by that is uh, within the retail and CPG ecosystem, there are so many categories and subcategories, right? In fact, to be honest, when I'm analyzing the data with Abhilasha and Akash, we also think that, okay, retail and CPG has so many categories and subcategories. How do we define them, right? Within CPG, you can have food and beverage, apparel, then you can have electronics, then within retail, you can have grocery retail, you can have specialty retail, you can have electronics retail. So in this case, what we are increasingly sensing from enterprises is that a service provider will come and say that, okay, I have this customer experience accelerator or toolkit without actually understanding whether that accelerator or toolkit is actually relevant to the client context. Let me take an example of retail. So in retail industry, in case there is a discount retailer, right, or a retailer which is having a high footfall, perhaps for that retailer, the focus is on frictionless checkout, right? And also ensuring, which is a part of customer experience, right? Frictionless checkout, helping the consumer get the right product at the right time through omni-channel experiences. Juxtapose this to somebody who is in consumer electronics space. Over there, their priorities are different, right? Over there, CX can be in terms of enablement of the sales executive through AI and generative AI in order to make the best product recommendations to the customer, which is evaluating the products. Also, at the same point in time, using advanced analytics to tell to a sales executive or maybe the consumer itself that if you are buying this product, this is a integrated product that you want to buy. I think the easiest example that comes to my mind is, let's say a mom and pop shop is wanting to have a audio visual setup within their ecosystem, and they come and say that, okay, I want to buy a big TV and I want to buy a point of sale ecosystem. Is there an opportunity in order for the consumer electronics good provider to also help them with self checkout stores, also help them in order to think through, do they need a printer? I know I'm talking very specific and very simple use cases maybe to many, but that's the ecosystem requirement, right? So in case of somebody in consumer electronics, the end result is, high touch customer selling in order to increase the basket value. Thinking about treating transformation as plug and play. One of the places where, at least in my experience, I have seen when we have been evaluating RFPs for enterprises is people say we will transform your entire ecosystem within 2 quarters, 3 quarters, because we have a plug and play solution. That is actually off-putting rather than actually helping the client think through that, oh, a particular service provider can help me transform. In fact, the conversation that Abhilasha and I were having today morning, the key complaint of the enterprise was that when we are talking about transformation and the way that we think transformation is materially different to what a partner thinks of transformation. Secondly, they are not understanding our key pain points as of this point in time and trying to help us, or try to not help, try to nudge us to spend on a transformation project which is actually not our core priority as of this point in time. So I think one of the ways that service providers can go around this pitfall is being very close to your clients. Okay, analyzing what their spend history has been, analyzing what their business objectives are, and then through business objectives coming up with solutions rather than the other way. Because we have a portfolio of products and solutions, let us take to a client and see whether it sticks or not. And in fact, that's the reason for Akash's point that you said previously is that the providers are not focusing on innovation. I think there's a nuance to it. While providers are focusing on innovation, that innovation is working only for a specific cohort of clients, not for a broader ecosystem of clients. And I think that's the key mindset shift that providers need to do. It's not that the providers are not capable of helping people in their transformation journey. Maybe they are hitting them on pain points which are probably not the most crucial priority for them as of that point in time. And the message that they are taking is not resonating. The other things are over indexing on low price wins. Again, as we know that within each enterprise, there is a provider ecosystem and there are tier 1 providers, tier 2 providers. I do not think tier 1 providers are the lowest cost providers. And in fact, for enterprises, it is about value, saying that how much you will be able to help in my margin and growth, rather than to Akash's point, saying that how many FTs will you be able to do? And this work I'm able to do with 2 FTs or one digital FT. In fact, that is also one term which is coming, which actually the underlying message over here is cost reduction or low price. Rather than taking 3 FTs, we'll do one digital FT. But I think providers are missing the message. Message is not whether you are replacing 3 people with one agent or one agent with 2 agents. The objective is what is the measurable impact that it is able to get to me. I think those are the key points which hopefully providers will address to. Also, another point is when Akash, you mentioned that analysis of 3.1% growth that we are anticipating doesn't mean that the incumbents alone will get it, right? There will be huge competition between providers, and it is for the provider community as a whole to say that, okay, whatever the net new spend is happening, we win a reasonable part of the pie. Abhilasha, what are your thoughts on this?
I think, Abhishek, you have articulated it beautifully. My 2 cents regarding that would be, I think, again, I'll be very brutal out here. But if a provider, if you are still confined in the role of a implementer in terms of your perception with your buyers, I think you are missing the bus. You will not be able to grow in that account if you're not looked as a partner, orchestrator, co-innovator. So that perception needs to be changed proactively day in, day out. That's one. Second, I think the biggest pitfall is that reusing the same playbook that we have been doing for the last 15, 20 years. Again, that's going to be a big deterrent in terms of your growth, your clients' growth. We discussed how mega forces they are evolving, how we are seeing big disruptions. So market is not easy, market is brutal. That's why you also need to adapt. You need to adapt your pitches, you need to adapt your playbook. That agility to adapt, that is a must. So that would be my 2 cents on the topic. And now I think let's start wrapping up this intense discussion that we had. So, Milan, if you can move to the next slide. For our audience, let's try to summarize what are the key takeaways that we have had from this session. So, the primary key takeaways from my perspective, based on what I heard Abhishek talking, what I heard Akash talking, would be that in 2025, first of all, the what we saw was that the players who were rewarded with growth, they were rewarded because of their operational model maturity, not market momentum, not size. So now we need to extrapolate this to future, and enterprises who are able to track and adapt early on things like ecosystem orchestration, not channel optimization, who are able to carefully assess what will make the needle move for you, not industry, not blanket statements, not the playbook that has been used by the overall industry, but specifically you. When we talk about things like what will work in terms of autonomy in AI, specifically you, that is important. That is very critical. So that future casting foresight mindset is important. If you have that, only then you will stay relevant in 2030, because we have seen massive shift in terms of top 10, top 20 players across the years. So if players want to be relevant, that's the future casting that's needed. Taking one example, cloud migration has been out there. Lot of players, lot of enterprises have done that full cycle, but still a lot of enterprises, especially the forward looking enterprises, they are doing that migration, that level of infrastructure investment again to build for future, to build for AI. So it's not done and dusted in one go. You need to keep on investing, you need to keep on analyzing, and you need to keep your operating model up to the mark, built for future. Second important key takeaway that at least I will take away from this discussion is how success it hinges on deep partnerships. So not broad vendor, preferred vendor lists and all that enterprises would have, but very tight value linked models. That's where the actual partnership between an enterprise and a provider partner, it sort of builds for future, builds for success. So ears to the ground, stay close to your accounts, and that be that sounding board for your enterprise partner. The third very important key takeaway would be again, it's all about domain. So domain expertise is a new, I would say, accelerator for AI and digital transformation, because enterprises, they really want to solve for their specific retail and CPG problems, not for wider industries. What might be working for others might not work for them. No one size fit all shortcut to all the transformation, all the initiatives that we are talking about. So domain expertise will play a pivotal role. Now, hopefully, this discussion shaped your 2026 thinking. Before we end the discussion, Abhishek, do you want to pick up maybe one or two interesting questions that we received during the registration, or any live question?
Certainly. So a lot of questions have come, and I'm glad that people are reacting to this poll and to the discussions that we had. So one question is, what percentage of investments are in AI, and what are the top use case areas? Now, I know, Abhilasha, there's no time for having one more webinar for 1 hour for discussing AI, but top of mind that you have observed in your interactions, right, from an enterprise lens. I think that would be most helpful.
Sure. So, from an industry perspective, I think we are blessed to be focusing on an industry which is not as regulated as the likes of banking or healthcare and life sciences. That's why we see higher adoption of AI in retail and CPG. Top use cases that come to my mind would be, again, we have talked about it, sales and trade marketing, digital commerce, content creation. I think these are the use cases where we are seeing very fast movement of AI use cases from POC to production. That's one. And the last thing is, I think the reason I'm very optimistic about AI spend or AI actually becoming more mainstream, the use cases is we are also seeing separate budget centers, separate roles, separate KPIs. So that accountability that's now coming in terms of the maturity that enterprises now they are bringing to the table, I think that is something that will actually turn the needle from AI adoption perspective.
Yeah, lovely. So I think the next question is, what share of the technology budgets in retail and CPG is shifting towards, AI? I know now there is no one answer that you'll give a magic number that 2% is shifting or 3% is shifting. But what's the perspective or what's the trend that you have seen? And I'll also like to chime in on this point.
Sure, sure. So, again, I think there is no specific number that I can point to that. But one thing that we are very certain of when we are speaking with enterprises is earlier, and again, it's not AI in isolation, AI in silos. It's a combination of data, analytics, and AI. AI will not be able to work in silos. So I really love this data point that we got is for every dollar spent on generative AI, enterprises, they need to spend around $3 to $5 on data. So that's a combination. That's the kind of drive that we are seeing. And data analytics and AI out of the entire IT and tech budget, that's the number one priority. So that's my directional view on it. Apologies, I can't fortune tell on the exact range here.
Yeah, so let me give you my perspective over here. So I think what some enterprises are doing, so again, it depends, right? If you are going for an enterprise which is not digitally mature, right? And you can make a sense, right, whether they are digitally mature or not. There you'll start seeing, oh, how much is it? 10% of my IT spend? Is it 6% of my IT spend? Is it 3%? But really innovative organizations, right? So again, in our experience, we work with many innovative organizations, and let me be honest, organizations which are not innovative. In innovative organizations, what we've started seeing increasingly, Abhilasha, as you know, is a separate fund which is called as the innovation fund. I know there's an innovation fund for any managed services deal as well, but this is the innovation fund which is coming directly from the CTO slash CEO. Okay. And that innovation fund is on disrupting or any technology which is fundamentally disrupting the way that an enterprise is working, right? And if you ask me, while there is a budgetary constraint, if a provider or a partner is able to showcase that, leveraging that innovation fund, they're able to unlock value, given that it is coming from the C-suite, there is no head or there is unlimited headroom for growth in order to take that innovation. The other thing is, as we already know, enterprises are happy to innovate and co-fund some of these innovations as well. But to the earlier point that I think Akash was making, that enterprises don't see partners coming up with innovation. They'll come with table stake solutions, they'll come up with accelerators, saying agentic AI commerce accelerators, but it is not really touching their business need. So, what share of technology budgets? Of course, there's no right answer. We can help you out with it in case you need because it will depend on the enterprise. But if you target the really innovative brands, then I don't think that, budget constraint is so much of a challenge. Which actually gets me to the last question that we can take, Abhilasha, which is something perhaps a reflection on you and me, right? Saying that we see analyst-led pursuits very high on transformation and budget impact themes, but traditional procurement-led deals are still in low costs, right? So how can providers and also enterprises, don't get us wrong, right? Enterprises also feel the pressure from procurement. How can they navigate this?
So that's true. I think we are on top of the hour, so I'll keep my answer very short. So that arbitrage, again, I think takes a priority in all types of deals that we are seeing. It's still not all rosy picture for AI, where every deal is all about AI. So that arbitrage, especially in procurement side of the house, still exists. So long answer short, we are still seeing that it will take some time for these mega trends to become mainstream. I know we are on top of the hour and we have some very interesting questions unanswered in our Q&A. So rest assured, we'll get back to you offline. But before we call it a day, just wanted to leave audience with a super exciting complimentary offer from Everest Group for pre-qualified registrants. So Yeah, thanks, Milan. So you can schedule a 30-minute complimentary session with us, with the retail and CPG team, and we can help you with two options that you have here. We can help you benchmark your tech spend versus peers, again, very critical for a lot of enterprises ahead of their AOP. Similarly, we can help you assess AI maturity of yourself or your clients versus peers. So those are the two options. Hit us up after filling the CTA form link, which is right there in the chat. And we have earmarked some of our latest coverage in subsequent slides. This tech will also be available for you for offline consumption. So that's a wrap for this webinar. Hope everyone enjoyed it and you walk away with some interesting perspectives. And I thank my colleagues and co-panelists for making this happen. We really enjoyed the discussion.
Toodles. Thank
Thank
you.
you,
Bye
everyone.
bye.
Thank you.